The United States has struck Iranian nuclear facilities. Israel has conducted coordinated bombing campaigns. And Iran has retaliated with ballistic missile attacks across the Gulf region. The Middle East, the world's most critical energy corridor, is on fire. And sitting thousands of kilometers away, India watches with deep anxiety. Why? Because India cannot afford to ignore this war. India imports 85% of its oil from regions that this conflict threatens. 9 million Indians work in the Gulf and send home nearly $40 billion every year. And India's most critical trade routes pass through the very straits that Iran controls. The question every Indian, every policymaker, and every student of current affairs must grapple with is this: how badly will this war hurt India? Today, we give you the complete, data-driven answer. Welcome to today's latest update. Today we are doing a comprehensive, structured analysis of the 2026 US-Israel-Iran conflict and its cascading impact on India's economy. I will walk you through this systematically. We will first understand the background and current status of the conflict. Then we will examine India's oil dependency and why it makes India so vulnerable. We will then analyze the direct economic impacts, on oil prices, on the rupee, and on India's fiscal position. We will look at the Strait of Hormuz scenario, what it means if Iran actually closes it. And then we will analyze India's response, diplomatic, strategic, and economic. Finally, I will give you the key takeaways for your competitive exam preparation and for understanding what this means for your daily life. Let us begin. The 2026 US-Israel-Iran conflict has roots going back decades. But let us understand the immediate trigger. Iran had been steadily advancing its nuclear enrichment program, reaching levels that both Israel and the United States considered an existential red line. After the failure of multiple rounds of diplomatic negotiations and increasingly severe economic sanctions that Iran found ways to circumvent, Israel and the United States decided to act militarily. In early 2026, coordinated airstrikes targeted Iran's primary nuclear enrichment facilities at Natanz, Fordow, and Isfahan. Iran's response was swift and escalatory. Tehran launched waves of ballistic missiles at U.S. military bases in the Gulf region, including bases in Qatar, Bahrain, and the United Arab Emirates. Simultaneously, Iran-backed proxy forces intensified their operations. The Houthis in Yemen renewed drone and missile attacks on shipping in the Red Sea. Hezbollah and Lebanon exchanged fire with Israeli forces along the northern border. Iraq-based militias targeted U.S. installations. The conflict has several dangerous dimensions. First, it is now a direct U.S.-Iran confrontation, not just an Israel-Iran conflict. Second, it involves multiple theaters simultaneously. Third, it directly threatens the Gulf Cooperation Council countries, Saudi Arabia, UAE, Kuwait, Qatar, Bahrain, and Oman, who are India's closest energy partners. The key question being debated in strategic circles globally is whether this remains a contained conflict or expands into something much larger. The honest answer is that no one knows. And that uncertainty itself is damaging to India's economy. Let us now understand precisely why India is so exposed to this conflict. India is the world's third largest consumer of crude oil, after the United States and China. India consumes approximately 5 million barrels of crude oil per day. Of this, India produces domestically only around 600,000 to 700,000 barrels per day. The rest, approximately 85 to 87%, must be imported. This is a structural dependency that cannot be changed overnight. Now, where does this imported oil come from? Historically, the Gulf region, comprising Iraq, Saudi Arabia, UAE, and Kuwait, has been India's primary source, accounting for approximately 55 to 60% of total imports. In recent years, India has diversified by purchasing large quantities of discounted Russian crude following the Ukraine war. By 2025, Russia had become India's single largest crude supplier, accounting for nearly 40% of imports. This diversification has somewhat reduced India's Gulf dependency, but not eliminated it. 40 to 50% still comes from the Gulf. India's total crude oil import bill in financial year 2024 to 25 was approximately 100 to 110 billion US dollars. This is India's single largest import item, and it directly determines India's trade deficit, current account deficit, and the strength of the Indian rupee. When oil prices rise, India's import bill rises. When the import bill rises, more dollars leave India to pay for oil. When more dollars leave, the rupee weakens. This chain reaction is precisely what is unfolding right now. Now let us talk about what is actually happening to oil prices and what it means in concrete terms for India. Before the conflict escalated in early 2026, Brent crude oil, the international benchmark, was trading in the range of $75 to $80 per barrel. This was already elevated compared to the pre-pandemic levels of $50 to $60. With the outbreak of active hostilities between the United States, Israel, and Iran, crude has spiked. Brent crude has crossed $90 per barrel. Analysts at major banks and research institutions have published projections ranging from $100 to $120 per barrel if the conflict continues at its current intensity. Some worst-case projections go even higher. What does each $10 increase in crude oil mean for India? India's import volume of approximately 4.7 million barrels per day means that a $10 increase in price adds approximately $47 million to India's daily import bill. Over a full year, that is approximately $17 billion in additional import expenditure. India spent roughly $105 billion on crude oil imports in financial year 2024 to 25. If crude averages $100 per barrel for the full financial year 2025 to 26, that figure could cross $130 to $140 billion. This creates massive pressure on India's current account deficit and forces the Reserve Bank of India to sell its foreign exchange reserves to support the rupee. The RBI has been deploying billions of dollars from its reserves to prevent a sharper fall in the rupee than what we have already seen. The Indian rupee is under serious pressure due to this conflict, and the mechanisms driving that pressure are important to understand. There are three simultaneous forces weakening the rupee right now. The first is the oil import demand for dollars. India must pay for all its oil imports in US dollars. When oil prices rise, India needs more dollars to pay for the same volume of oil. This increased demand for dollars relative to rupees pushes the exchange rate higher, meaning more rupees per dollar. Second, there is the risk-off flight to safety. When global geopolitical uncertainty spikes, as it has with this conflict, international investors tend to exit emerging market assets, including Indian stocks and bonds, and move their money into perceived safe havens such as US Treasury bonds, the Swiss franc, and gold. When foreign investors sell Indian assets, they convert rupees back into dollars, further weakening the rupee. Third, inflationary pressure from higher oil prices reduces the real return on Indian assets, making them less attractive to foreign investors. The rupee was already trading above 87 per dollar before the conflict intensified. Analysts see it moving toward 88 to 90 per dollar if oil prices remain elevated and the conflict continues. Every 1 rupee depreciation against the dollar increases India's oil import bill by approximately 3 to 4,000 crore rupees annually. The Strait of Hormuz is the single most dangerous choke point for India in this entire crisis. Let me explain why. The Strait of Hormuz is a narrow channel, approximately 33 kilometers wide at its narrowest point, connecting the Persian Gulf to the Arabian Sea. Through this channel flows approximately 20 to 21 million barrels of crude oil per day, roughly 20% of total global oil supply and nearly 30% of globally traded liquefied natural gas. Iran has repeatedly and explicitly threatened to close the Strait of Hormuz in response to any military action against Iranian territory. With US and Israeli strikes now having occurred, Iran has renewed these threats. For India, Strait of Hormuz closure would be catastrophic. Not only would 50 to 60% of India's Gulf oil imports be disrupted, but the resulting global oil price spike could push crude to $150 to $200 per barrel. India's strategic petroleum reserves of approximately 5 million metric tons, equivalent to only 9 to 10 days of national consumption, would provide only limited buffer. This is far below the International Energy Agency's recommended 90 days of strategic reserve. Building adequate reserves is expensive and takes years, making this a long-standing vulnerability that this crisis has exposed sharply. India's response to the US-Israel-Iran conflict reflects its traditional foreign policy doctrine of strategic autonomy, maintaining friendly relations with all parties and avoiding alignment with any single bloc. Prime Minister Modi has personally spoken with the leaders of the United States, Israel, Iran, and Gulf countries, calling for de-escalation and dialogue. India has not condemned any specific party. India voted to abstain on most UN resolutions related to the conflict, maintaining its characteristic non-aligned position. On the economic front, India is actively pursuing several strategies to mitigate the impact. First, India is continuing to expand its Russian crude purchases, taking advantage of the significant discount that Russian oil trades at relative to international benchmarks. Second, India is engaging with Saudi Arabia and UAE to secure long-term supply contracts with price caps and flexibility provisions. Third, the Indian government is working with oil marketing companies, Indian Oil, HPCL, BPCL, to manage retail fuel prices and prevent panic buying. Fourth, the Reserve Bank of India is actively intervening in foreign exchange markets, selling dollars from its reserves to prevent excessive rupee depreciation. Fifth, India is accelerating approvals for renewable energy projects to reduce long-term oil dependency. Let me now give you the key takeaways from today's analysis. The US-Israel-Iran conflict poses genuine and serious economic risks to India. The three most important risks are, 1. Sustained high oil prices increasing India's import bill by $20 to $30 billion annually, 2. Rupee depreciation making imports costlier and pushing up domestic inflation, and 3. The tail risk of Strait of Hormuz closure which would be severely damaging. India's response has been measured and strategic, maintaining diplomatic balance, diversifying energy sources, and managing forex reserves. The fundamental vulnerabilities remain: high oil import dependency, inadequate strategic reserves, and a current account deficit sensitive to oil prices. For UPSC and State PSC aspirants, this topic touches GS Paper 2 on India's foreign policy and international relations, GS Paper 3 on India's economy and energy security, and Mains essay on geopolitics. Keep tracking this evolving situation. If you found this analysis helpful, please like and share it. Subscribe for daily current affairs updates. Thank you for watching.